Welcome back to the Behind the Wealth Show. Your host, Roger Abel, back with Elias Randall. Elias, a lot of big news going on this week. The Fed met yesterday, and we're cutting interest rates again. Any thoughts on that?
Big news. Federal funds rates going down.
You want to know what's really ironic?
Treasury yields remain unchanged.
10-year yield went up 10 basis points. It was 398. It was trading 410 this morning.
Yeah, so relatively unchanged from the last rate cut to now.
Yes, but they cut the rate. They cut the Fed's funds, and the 10-year went up in yield.
Yep.
Which people don't expect that. I was reading a bunch of articles last week talking about how there was this mad dash of mortgage refis that were happening because we got rates under 5. Not under 5, under 6%. In fact, I think I saw some 15-year rates at like 5.4, which those are, if you're getting an interest rate in the 5s, that's a pretty fair interest rate to finance something.
Not bad. It's not 3.
I don't know if we're ever going to see 3 again. That was
people
0.
Say that, but every time people say that, it happens again.
That was the first time we've ever went to under 3.
Mortgage rates have been pretty close to 3, more than just when? 2021?
No, I'm saying over the last 20 years, mortgage rates have not been under 3 very often.
Close to 3. I'm saying something in the 3s.
I'd say it's mostly in the 4s. You had a period like a few years. I just don't think I don't think we're going back to zero interest rate policy. You remember this is a good conversation because your bias as to how long you've owned a home. When you bought your home, it wasn't 3. When'd you buy your house? 17?
Yeah, I'm trying to remember our first rate on
so
the
in
house.
17,
I think maybe when I bought,
you were over 5.
When I bought my first house, I don't know that I've ever had a mortgage rate over 5, to be honest with you.
So I can tell you in 2003, bought my first house. My rate was 5.25, 5.75, and that was on an ARM, so it wasn't fixed. And the banker's like, man, that's a good rate. Might never see this again. And it went down. And I refinanced that into the 4s at some point. I built a new house in 2017. And I remember I did a 10-year adjustable because I was going for the lowest rate. I'm like, I don't plan on being in this house 10 years, so why do I need a 30-year fixed rate? And I want to say my rate was like 4.5 when I did that in 17. And then in 2020, 19 or 20 is when, probably 2020, I have to look back, when rates like massively dipped. And I got refinanced at 2.75. And I've been there since. But the only time we've ever been under 3 in my 20 years of owning homes and mortgages was 2020 when we lowered the Fed funds rate basically to 0.
Well, it may not happen again.
But I think what's ironic is your bias is that, 3 is a normal rate. Really, the normal rate's probably higher, closer to 5.
I don't think I'd be that surprised to see rates go back in the 3 again, but maybe that's my bias. I've gotten lucky every time I bought a house.
Well, you owned the house and dated the rate.
But now that we're talking through it, the first house I purchased was on a 10-year adjustable rate mortgage.
Yeah, and you typically get a little bit lower rate.
And then the second house I bought was on a 30-year and then refinanced.
Okay, I pulled up the average 30-year rate going back to my first time I bought a house. So that's 2003 is when I bought my first house. So 2003 was 5.83%, 05, 5.87, 06, 6.41, 07, 6.34, 08, 6, 09, 5. We didn't get down into the 3s. First time we saw a sub 4% interest rate was 2012 coming out of great financial crisis. 3.66 was the average, then 3.9. Then we were at 4, 3.99, 4.54.
What year did it go to 3.99?
17.
Yeah. So I see. I always got lucky
Yeah.
because I think I purchased my first house right around 2012.
So we've spent the last
Second house was 2016 or 17.
We've spent most of the last decade around 4. Just interesting.
Yeah.
Because
I should keep my house. I shouldn't sell it. That's my takeaway from today. I should never move.
No, I don't think that's necessarily the answer, but I think your answer of never selling it. I look back to the 3 homes I've owned. I've owned 2 previously, 2. And each one of those homes, I wish I never would have sold. Because 1, I know what I could rent them for, and they're not junky homes. I built 2 of them, like they're nice homes, but I'd be able to get a good tenant likely, and the appreciation on both of those homes now would be amazing, and they'd both be paid for. Like I literally wish I never sold those, but then I look back and say, well, at that time in 2009 when I sold my other house, I didn't want the risk of owning 2 homes and 2 mortgages and all the things that go with that. And I also know, well, Elias, you know me, I can't fix anything. I barely can paint anything. But yeah, you shouldn't sell that
property
house.
management company.
You're going to start one?
No. I'm asking, have you considered that?
I think by the time I do that, I might as well just stay in my lane, buy an investment that I'm familiar with and I'm comfortable with and I know how it works. And I mean, I think if you have a property management company for one place, I don't know if the numbers work out for one place or if you need a bunch.
Yeah, you'd still get the appreciation on the asset.
Yeah.
You don't need the income. It really doesn't matter.
There's other real estate assets you could buy, though, that
True.
I can get appreciation and not have to deal with
Tenants.
I mean, you buy a commercial building, I would
Yeah.
think those tenants are better than the average homeowner tenant in general. You're not going to get calls at 11 o'clock at night that my toilet's backed up. And all those things go through my mind. Like, oh yeah, by the way, air conditioner went out in the summer night on July 4th at 1 a.m. and we need to get it fixed. That's all that goes through my mind when I think about having rental properties of any kind. Elias, yesterday the Fed did meet. We cut the rates like we talked about, mostly because inflation back under 3%. And the concern now is the labor market is softening. And I listened to Jerome Powell's talk yesterday. And one thing stuck out to me, that job creation's very low. There's almost no new job creation. And if you are out of the labor market, it's difficult to get back in. We're still at 4.3% unemployment, which is historically low. We came off a 3.6, which we see what a 3.6 unemployment rate does. It just fuels inflation because people are jumping from one job to the next for the next 20,000. You remember that. Well, what did we coin that in 2021 or 2022 when we were talking about the workers that would jump from job to job to get the pay increase?
Wasn't it? Oh, it was the Great Resignation.
There you go. Great resignation. Well, that's over.
Do you think this is supporting the soft landing? Are we experiencing a soft landing? So that's what they set out to do. Is that what's happening?
Good question. Maybe. It'd be pretty well engineered if they do. I mean,
seems like people are a lot more worried about smaller and medium-sized companies than they are large companies too. No one seems to be worried about any of the big companies.
I think
all the risk is in the smaller ones.
And I think it's in private credit.
Yeah.
That's where the risk is at. We saw a couple of big companies default, which I believe Bank of America owned them. And it's primarily revolving around subprime auto loans. But private credit and the ability for a private company to go lend money to businesses without the same regulations that a bank has could be the canary in the coal mine. And we mentioned before, as soon as they want to open up the private credit markets for retail investors to buy, that means they're going to have to take on potentially loans they wouldn't normally do as there's more demand for the products. We talked about
That's
this.
Interesting. I just heard an argument yesterday that there's further risk involved with private credit right now.
There's further risk?
Yeah, for the things you're talking about, the subprime auto loans, and then if there starts to be redemptions, and
well, just think about it.
A lot of things could go wrong.
If you go to the bank as a company and they won't lend you money, where do you go? Private credit markets.
Yeah.
And then imagine we put these.
Yeah, subprime auto lending just.
Isn't it just kind of greasy?
It sounds greasy. I mean, if you can't get a loan from a bank to buy a car, then I don't.
The rates are, what's the average rate? I want to say they're
right.
well north of 10% to buy a car.
Wonder how many of those get repossessed.
I think a vast majority. That's
got to be predatory lending.
It's probably part of the business model.
Well, yeah, you sell a car, 12 times to 12 different people.
Right. They pay for a little while. It's almost like just leasing or renting the car.
Yeah, what a greasy, I don't know. That seems like a greasy business to be in.
The point of discussing the interest rate market in general is just because the Fed funds rate got lower doesn't mean you're going to see that reflected necessarily in mortgage rates and some of those rates. Where you will see it reflected is going to be in your bank savings rates, credit card rates, and some of the short-term type rates that are out there should see some benefit from the overall lowering of the inflation rate.
Federal funds rate, you mean?
Yeah, I'm sorry. I apologize. The federal funds rate.
Well, hopefully some people can, I don't know ultimately if it's enough to get relief from credit card debt and other debt vehicles. I think at the end of the day, the best way to get relief from those things is to get your debt paid off, not carry balances, have a mortgage on a home you can afford. So I think consumers are pretty tapped out right now. I think the good news is for people, we're just talking, job creation has slowed. That's understandable. I think the one thing keeping unemployment rate where it's at is employers are really unwilling to lay people off because it's so hard to get people back. So that's kind of playing into the hand of workers right now, where maybe you're not getting overtime, maybe you're not getting pay increases like you would when times are better. At least you still have your job.
Yes, but you just saw Amazon. Didn't Amazon just lay off like 14,000 people?
Amazon's a huge company.
But that's
a lot of small businesses or small and medium-sized companies are holding on to people. It's harder for them to find labor.
I agree with that. Amazon, this is from Reuters 3 days ago, they target 30,000 corporate job layoffs.
30,000?
30,000. That's a big number.
Yeah.
Like, that's not, hey, we're laying off. We have locally here, you hear John Deere shut a plant, laid off 200 or 300 people. 30,000. It's like 1% of the population of our state. And it all revolves around AI. And what's interesting, these are corporate jobs. They're not, these are white collar jobs. They're not blue collar jobs. They're corporate jobs. And they're going to have to go find another corporate job. And I just I'm curious as to how that plays out long term. I mean, we know the power of.
I have no idea.
We know the power of AI and what it can do and how it can make things more efficient. Do I trust it? Not all the time. You got to verify it.
I don't trust technology. I'm kidding.
I know you don't. When I hired you, I thought you knew about technology. You're like, nah, I'm not. I'm not one of the youth that learned technology, apparently. That's okay.
I'm pretty good at it now.
We should ask Molly. Hey, we got a quick listener question that just came in. It says, I have quite a bit of money in a mutual fund, which has done well. The fund is not in a retirement account. I feel a significant decline in the S&P 500 in the near future. I think people are clearly thinking this too. I have a considerable amount of unrealized capital gains in this fund and can't decide whether selling some or all of it and paying the taxes makes sense, or if I should just wait through the coming decline. I am 67, retired. My wife and I have income of $200,000 from IRA withdrawals. What do you think?
Well, I get where this question's coming from because the market's been on a roll. But what's driving the fear? I fear a significant decline in the S&P 500. Well, what's driving that fear? Just because it went up, you think it has to go down in a correction? There's a lot of compelling arguments for the bull market to continue. So what I would want to know more about, what is driving the fear in this person?
That's good insight. I think the question I would ask is, what is the catalyst to a decline? What do you see that makes you believe it's going to go down dramatically?
Yeah,
because that differs. Well, okay, what kind of an event? A black swan event that we can't predict, that just happens.
Right. That's, to me, that is the biggest threat right now. The companies are healthy. The earnings reports are good. Market's pretty fairly valued. I mean, maybe on the high side of fair value, but
high side relative to historical standards, not the last 10 to 20 years.
Correct. I agree with that.
We've talked about, the moving P ratio.
I agree with that. So outside of global pandemic, I suppose, okay, let's say some sort of systemic event like with the subprime auto loans and private credit market tightening up, but I don't really know that would impact the publicly traded companies.
I don't know as if subprime auto loans would, but but private credit to businesses might.
Definitely could.
I don't know how much has been lent, but we have pockets of the real estate market that are depressed. But here's what I would ask this listener. You have income of $200,000 a year from IRA withdrawals. So let's make an assumption that this individual is doing this themselves. That's why they're likely emailing the show. They're probably utilizing the 4% rule, right? Just likely,
it's a reasonable assumption.
It's a reasonable assumption. So they got $5 million in IRAs. I think the question really is, who is this money meant for? Is this money that you plan on utilizing in your lifetime, or is this money that likely is going to go to your children? And here's why I asked this question. It's really important to figure this out. If this money is for your kids, grandkids, beneficiaries, whoever it might be, you likely should just write it out. The reason is the time frame and life expectancy of you plus them is a lot. And what they have the ability to get when you pass away is a stepped up cost basis, meaning they would pay no tax on the sale of this S&P 500 fund after you pass away. So this individual family needs to segment their assets a little bit and figure out what's in bucket one, which is that liquid bucket. What's in bucket two to generate income, which is apparently $5 million in IRAs. What's in bucket three for growth? And maybe this S&P 500 fund is actually in the legacy bucket. They just haven't identified it that way yet.
Yeah, that's good insight. I think I don't really view this is a little bit of sidebar, but it says a mutual fund. So it doesn't say that it's in the S&P 500. I don't know that mutual funds are great just trading vehicles in general. I feel like if you're a type of investor that decided you're going to buy a mutual fund, well, one, you're already outsourcing the stock picking to someone else, buys and the sells. So there's a little bit of this doesn't seem like a trader. This isn't someone who's actively trading their accounts. So I think keep in mind too the type of investor you are. When you bought this mutual fund, I think you bought it because you wanted to be a good long-term investor. So the decision might be as simple as I'm going to continue doing that.
Here's the other thing I'd want them to go find out. What is the unrealized capital gains? They may just be looking, Elias, at, because it's a mutual fund, we put in $100,000 30 years ago, and now it's worth $500,000 today. Just making up a number, right? If it's a mutual fund, they've likely paid and received capital gain distributions along the way. The tax liability may not be as high as they believe. But back to the original question. If you're concerned about a decline, here's how I would break it down. One, who is most likely to use this money? If you say it's probably for a beneficiary, then you probably write it out. Second, if you know you're going to need it and you need the money, we do have a little saying in this office that not selling because of taxes isn't a reason to sell.
To not sell?
Yeah.
Yeah.
I mean, if you're paying 15 or 20% capital gains and you're choosing to not sell because of taxes, well, that investment can go down just as quick. I definitely adhere to that more.
15% decline, same thing if you're in the, right?
I would definitely use that more if you were doing individual stocks, because when you own an individual stock, there's no real guarantee that if it goes down, it's going to come back, right? It just go down, stay down forever. Where if you're buying a diversified mutual fund, ETF, while there's no guarantee it's going to come back, history shows us over time, the likelihood of it having a loss and then getting back to where it was before is pretty great. So don't necessarily sell because of a tax reason. I think the best thing to do is take a big picture view of this. Sit down with your advisor. If you don't have one, find an advisor and really determine what's our risk capacity, how much risk do we have to take to be successful, start to give our money some goals and priorities so that we don't have to make decisions based upon what we believe or what event might happen that we don't even know about yet. You can't control a black swan. You can't control these events. And people for 7 years have been predicting stock market crash. Where
Longer
is it?
than 7 years. People have been
Forever.
predicting, for a long time.
So that's my take on what this individual likely should do.
At the end of the day, the longer the bull market goes, the longer it goes. So I'm really not that bearish right now. Outside of an event, I don't really know what's the catalyst to a big correction in the market.
Well, let me ask you a question. Why would somebody be bearish when the market's up 75 to 80% of the time? Like, wouldn't you rather just be right 75 to 80% of the time than trying to pick the needle in the haystack of when something may or may not happen? And if it's clear that it's going to happen, it's already too late. Like, once it's clear something's happening, it's already too late.
Yeah. It's recency bias or greed and, everything's been going great. It has to take a turn for the worst. And then I think people either fearful, this person sounds fearful, or maybe they're greedy and they want to try and time the market. But I would stick with it. And is there really that much bad news right now?
Well,
from a capital markets perspective,
not really.
That's what I'm saying. Most of the news I'm reading and watching, there's not a whole lot of negative news about capital markets. It might be presented in some sort of sensational fashion, but there's not a lot of bad news right now.
I agree with that.
Maybe
the problem
maybe
is
globally, and there's
people will latch on to a bias. People follow headline news. You know, it's like if you watch the nightly news with David Muir, breaking headline, this just in. Every night there's a new breaking headline, this just in. Every single night.
No, it's not. It's not just in. You knew you were going to talk about that tonight.
I mean, literally every night I watch it, I always get a kick out of the first 3 minutes. He's going to summarize what he talks about. He's like, breaking news, this just in. And he looks like a guy from my high school, so I like watching him. But I just don't think there's that much out there that says this market's going to collapse. I mean, we can look back to the chart of over the last 30 years of all the reasons to not invest, and you could have found a bunch this year. I mean, a lot of them. And if you found a reason, to massively underperform.
And how well are this year, especially diversified investors, how well are they doing? And investors that didn't make any mistakes the last couple of years with their portfolio
diversified
strategy.
Well, here's who's done really well. People who still are concentrated in growth and international. If you own value and dividends, those haven't done anything. Go look at
right. What I'm saying, if you're diversified and you have a good diversified portfolio, you've participated.
You should have done well.
Unless you're okay. I've been all value and dividends because you thought that was going to be the play. I'm saying investors that keep a broad portfolio.
You know what? You hit it up. You hit it right there. There's different types of market timing. We always think of market timing as in the market or out of the market. There are investors who try to time segments of the market. Oh, I think this is going to happen, so I'm going to be all value, or I'm going to be all small cap, or I'm going all growth. That's another way to time the market. It really comes back to Warren Buffett's great saying that, owning the stock market's admitting defeat. Like, you're admitting, I don't know what's going to go up and go down. So there's going to be years where I'm going to outperform the S&P 500 and I'm going to underperform it, which it's really odd that that's just the benchmark because the S&P 500 is driven by 7 companies now. Think about it. The 7 largest companies, the Mag 7 is pretty much what drives most of the S&P 500. It's not an equal weight index. NVIDIA just went over $5 trillion.
It's an easy way to measure performance. I think that's
but
why
really,
most people
if you look at it, wouldn't you agree it's more of a growth style index at this point?
Yes.
And I don't know if it was traditionally set out to be that way, but it's turned into primarily growth style investment.
Yeah, because it's not equal weight, so it's
just go look at
whatever
that compared to the total stock market index.
Best performers are in the index is going to be really what type of index it is, right? If all of a sudden dividend and value companies started outperforming growth, then it would switch.
That's true.
Probably good reason to own it.
Some of it, right?
Yeah.
If anybody out there is looking for help getting started on your financial plan, if you have a question that's important to you, like this last one we just got, reach out to us at btwellshow.com. We would be happy to answer your question on the show. If you're thinking about it, it's probably likely somebody else is thinking about it as well. And we want to share the information with everybody and all of our listeners. I want to thank everybody for listening. If you haven't done so, please subscribe to the channel if you like to get content like this on a regular basis. Thanks for listening. Hopefully you tune in next week.
Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. The opinions voiced in this show are for general information purposes only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial or tax advisor prior to investing. Premier Investments and Wealth Management and LPL Financial do not provide tax advice. Please consult your tax professional. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. There's no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification does not protect against market risk. Rebalancing a portfolio may cause investors to incur tax liabilities and/or transaction costs, and does not assure a profit or protect against loss. All performance referenced is historical and is not a guarantee of future results. All indices are unmanaged and cannot be invested into directly. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risks, including possible loss of principal. Rebalancing a portfolio may cause investors to incur tax liabilities and/or transaction costs, and does not assure a profit or protect against loss. Dollar cost averaging involves continuous investment in securities regardless of fluctuations in price levels. Investors should consider their ability to continue purchasing through periods of low price levels. Such a plan does not assure a profit and does not protect against loss in declining markets.